This is Brian Putt. Thanks for joining me on the fifth video about the Lone Star drilling. This video will talk about the Lone Star drilling NPV distributions and the capital efficiency chart. If you're not familiar with the problem, I would suggest going back to the introduction of Lone Star drilling opportunity and view that, and then come back to this fifth video. Moving on. So let's look at the NPV of our wells. This is without information. So the black line here, this black line, represents the NPV of MJ1. And we can see that MJ2 is the orange line and almost is identical. It's a little bit different. And we can also see from this chart that there's like a, we'll call that 67% chance, something like that, of getting a positive result. Actually, I think there's a 65% chance of developing it, but there's some negative outcomes down here that make it lower it a little bit. So we can start to interpret from this S-curve, what's actually happening. However, because the two fields are independent, when I add them together probabilistically, now my probability of success is actually 50%, having a positive NPV. Possibility to develop one or the other looks to be more like 42%, or excuse me, 1 minus 42%, which would be 58, but 58% if I did that right in my head. And we can see the expected value is 2.14 for MJ1, 1.9 for MJ2, and 4.05 for the combined, which would be the combination of these things, right? Expected values had. So if MJ2 is worth $1.9 million, that's that orange line, on average, would you sell for 0.5? What is your risk preference? What are the tax implications of selling, which are not included in this model? Now, there's another way to look at these projects, and this is used by some companies, and there's a economic term called Profitability Index. And the Profitability Index is defined as the net present value divided by the present value of the investment. So here I've shown a 0.3 criteria. Is 0.3 the right criteria? I don't know. It kind of depends upon your portfolio of your whole company. What is the kind of the typical cutoff that you would have for doing a project or not? So that would be something you'd have to look into. And it may depend upon whether it's exploration or you're already into the investment phase, or would be going into the investment phase. It's appraised. So if I look at MJ1, it has a present value of the investment is, I think it's $8 million. $8 million. And an NPV of a little over 2. If I look at MJ1 and MJ2, so now this is adding incrementally the MJ2, you can see this line moves, this dot moves over to here, and the slope of this line is less than my 0.3, meaning that adding MJ2 as less than a 0.3 PI criteria. So if that was my hurdle rate for doing a project, I really wouldn't do MJ2 in addition to the MJ1. I would pass on it. And that reflects the probability of not developing MJ2. However, your risk preferences for this kind of, that MJ2 might be different than a 0.3. It could be a 0.1. And if this slope were to lower to a 0.2, that means it would go through this point, through here, and then I think we'd find out that MJ2 was profitable. So getting the right hurdle rate is important.